Hello, everybody, and welcome to Leading Indicator, a show by Public.com focused on gaining insight from the world's best macro minds. I'm your host, Anne Berry, and we're here with you today to gain insight into the Chinese economy. Don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews that will help you keep up with the latest investment news. Joining us today, we have George Magnus, Associate at the China Centre at Oxford University and former Chief Economist at UBS. George, welcome to Public. Thanks very much for joining us. George, set the stage for us. China has been experiencing slightly spotty economic growth in recent times. The second quarter GDP growth came in below estimates, which had been 7.3%. Actuals came in at 6.3% year on year. Help us understand how China, which many investors have seen as really the engine of growth at a macro level for so much of the global GDP, has been on a bit of a slowdown, perhaps more recently.
Yeah, okay. Well, this is an important question. I'll try and answer it as succinctly as I can. I think there's two kind of key points to note, really. The first is that, as you indicated, there's quite a lot of disappointment, not least in Beijing, that the hoped for economic bounce back following the abandonment of zero COVID late last year hasn't actually come to fruition, right? So we had a bit of a flurry of retail spending in the early months of this year, particularly in things like hospitality and tourism, transportation, leisure, eating out, and so on. Kinds of things that, we're quite accustomed to from our own COVID experiences when people feel comfortable about getting back together and meeting and so on and so forth. But it didn't really last, and investment, particularly private investment, has been really weak. So it's actually dropped in the first half of this year compared with 2022. For the first time since numbers of private investment were being collated, which was about 2005. Exports have been really disappointing because the world economy isn't exactly on fire, but that's kind of par for the course. But the real big disappointment really is the failure of the consumer to step up. So it's tempting to think about this as a COVID hangover, and a lot of people have kind of alluded to the fact that China's got a kind of an economic version of long COVID. I don't think that's correct myself, because most of the problems China has predate the pandemic in 2020.
Right.
So we're talking about too much debt, difficulty of paying bills for local governments, for example, a repressive consumer, a repressed consumer rather, a repressive or regressive tax system. Lots of problems actually have been accumulating for years, and COVID has just kind of made them worse. But the problems are not to do with COVID specifically.
But before we talk a bit more about some of those secular challenges, George, let's talk a little bit about data and the ability to gauge some of the changes that you've just described. Consumer spending, you've talked about as being suppressed relative to what investors had hoped. Consumer confidence data has been quite difficult to get out of China recently. Can you talk a little bit about some of the data that's available or not at the moment?
Yeah, it's quite difficult to get because the government cancelled the publication of a consumer confidence index, which it's been publishing for about 30 years. So because it failed to rally the way that I suppose the government hoped it would, they've just stopped publishing it. So now we have to guess what consumer confidence is. But I mean, there are a lot of kind of secondary indicators, that we can look at. I mean, for example, a lot of people are looking at youth unemployment, which is now at a record 21.3% in July. Okay, so what this is about really, I mean, it's the young people that are unemployed or registered as unemployed, I mean, are a relatively small proportion of the entire youth population. But I think what that tells you is that there's a huge amount of inactivity on the part of young people. In other words, people, either graduates, for example, they churn out 11 to 12 million graduates every summer. And so a lot of these people are actually not finding work. They are staying at home with parents to get, parental income for kind of local jobs in the house or on the farm or something. So there's a lot of kind of problems with younger people, and they are about 18 to 20% of consumption.
Mm.
Plus, we know that income growth in the Chinese economy is not growing very quickly. Before the pandemic, we had personal income that was growing at about 10% a year, and now it's probably growing by about half that amount. So these are kind of two, relatively easily findable indicators of weakness in the kind of basic consumer structure.
And in the US news cycle, in analysis of the US economy, there is so much focus on the consumer, George, because consumer activity, consumption is such a massive part of GDP, or the consumer related sectors relative to some other economies. If you look at China's historical saving rate, it's traditionally been much higher than we've seen in the US. And we've seen household consumption account for less than 40% of China's GDP over a relatively long stretch of time. Is China, from a policy perspective, trying to shift consumer spending upwards and to get that savings rate down? Talk us a little bit through fiscal policy and what the government's actively trying to do to create structural changes if that's what's needed.
Yeah. So they'd like to do that, I think. I mean, there's been in some respects, quite a comforting flurry of Chinese economists, including some people that used to be officially employed, right, as advisors or officials, basically speaking out and saying, we have to do more to strengthen demand, we have to do more to stimulate consumption. And in order to stimulate consumption, we have to stimulate people's incomes, because otherwise, how are they going to spend? So this is a healthy development, but it's not one which the government has really taken on board. And I suspect the reason they haven't really taken it on board is because there's a political and institutional resistance to doing the kind of thing that we would consider in, like, richer or developed economies, we would consider it a natural thing to do. But China has a different kind of approach to this, and Xi Jinping's view about the economy, he's not supposedly the kind of biggest economic brain on the planet, apparently, but he certainly has good advisors that could tell him, should tell him, what works and what doesn't work. But his idea is that if you can just build out China's prowess in science and technology and become self-reliant, which is basically what their objective is in vast swathes of industry, that all the benefits will trickle down to households, workers, citizens, and so on and so forth. So it's a very kind of different approach. We would say, for example, why don't you, overhaul the tax system? Because very few people pay income tax, and the lion's share of tax revenues, or a very substantial proportion, comes from value-added tax, which is a very regressive tax.
Mm.
We would say, why don't you kind of expand and develop the social welfare system so that people that save a lot of money because they're economically insecure will save less, because then they'll know that the state stands by to support them. Why don't you invest more money in education and in creating good jobs, rather than seeing this huge drift of people into gig economy, informal employment, which is low pay, low skill. So there are a lot of things the government could do, but all the things that it has been talking about really since zero COVID was abandoned late last year. And they've talked a lot about consumption measures and announced a volley of targeted measures to change consumption patterns and consumer products so that they want to sell more. But unless you do something about people's income, it's not really going to have much effect. So that's the problem, I think.
Well, George, on the monetary side, though there was proactive stimulus during COVID, we saw rate cuts, and really now inflation and China has begun to plateau. We're seeing a flat growth rate as of June. And the Chinese central bank has decided to cut key interest rates for the first time in 10 months. What do you think about that? What do you think about this move signaling the end of Chinese inflation and the shift back towards more stimulus from a monetary policy perspective?
Uh, to be brutally honest with you, I don't really think about it very much because I don't think it's really very relevant, which is not to talk unkindly about your question, which I think is absolutely genuine. But I think there's a limit. I mean, we've seen this a lot of times in our own experience, in the financial crisis and afterwards, and then during the pandemic and subsequently, where monetary policy, particularly on the easing side, doesn't seem to
Mm.
have much of an impact because it's not that people find that credit is too expensive. It's just they don't want to borrow money. There's just no credit demand. And in China, although local governments and state enterprises have almost a voracious appetite for credit, too much, I would say, private firms and entrepreneurs and households don't really want to borrow. And they don't really feel very confident about spending, in the case of private firms, they don't feel very confident about hiring or spending money on investment. So I think I expect the People's Bank of China to continue to ease monetary conditions, provide plentiful liquidity, cut leading interest rates, as and when, reduce reserve requirements for banks. But I really don't think that these measures are where it's at. So they're not really going to be game changers.
Just to push on a little bit of that, George, though, one area where we did see a lot of credit dispersed in the Chinese economy and where there has been varying amounts of coverage about whether there was a crisis looming is in real estate. We saw that in the commercial real estate side in China. I believe it was Evergrande, which sustained huge losses. I think even as of last month, this is July, Evergrande maybe $81 billion in losses during recent times. We're also now seeing new homes sales plunging in China. So for the areas where credit and interest rates have clearly hit quite hard, what do you think about there being ripple effects from these sectors into the rest of the Chinese economy?
Yeah, so here's a kind of classic example, really, about how you can funnel, year after year after year, you can funnel credit into real estate, is what has happened. And then, you basically find out that a lot of that credit went into kind of uncommercial developers or projects that didn't make money, or they just bloated the balance sheets of private sector developers to the point where their liabilities basically just grew out of all proportion to the value of their assets, and that's kind of where we are. So the idea now about credit flows into real estate is fills a lot of people with horror, because that's really kind of what exacerbated the problem in the first place. So that there has to be a shakeout in the Chinese real estate sector. There was a very famous paper that the American economist Ken Rogoff
Mm-hmm.
and one of his associates wrote a couple of years ago about how big the real estate sector in China had become. Now, by their estimates, the broadly defined real estate sector, which includes housing construction, home services like renting and mortgage advice and so on, the kind of white goods that go into new apartments, and the commodity content of like steel, glass, cement, and so on. You add all that together, they reckon that the real estate sector in Japan, relative to like 20 other countries they looked at, was about 29% of GDP.
Sorry, this is China.
This is China, right?
Yeah.
So this is higher than any other country
Yeah.
except Spain. Spain didn't come quite up to that level, but it was close. This was in 2000, before the financial crisis. But okay, some people have kind of queried the numbers. They think it may be a little bit lower, but nobody really thinks it's much less than about 22, 23% of GDP. And that's huge. You can't just replace that when the sector goes into like permanent shrinkage, which I think is what is happening.
And so when you, just to come back to this point of connecting monetary policy then to call it 30% of GDP, Do you think that the rate cuts are going to help at least kick the can on a reckoning, if there is going to be a day of reckoning for the sector? Or do you think that this is just indicative of the fact that both fiscal and monetary policy need to start to see reform to change the growth trajectory of the country?
Well, one of the things that have caught people's attention in response to your question, one of the things that has caught people's attention in recent weeks is this idea about China being on the cusp of what people call a balance sheet recession, right? So
Mm.
this was a phrase coined by a one-time junior researcher at Nomura in the kind of late 1980s, early 1990s, who's still active, but he's obviously a big cheese now. His name's Richard Koo, and he correctly identified the problems that affected Japan following the bubble bursting in 1990, which condemned, Japan to decades of stagnation as
Mm.
people sought to dispose of assets and pay down their liabilities.
Yeah.
Right. So I don't think this is precisely what's going on in China, because I don't think the private sector, private industry in China is as indebted as it was in Japan in the 1990s.
Right.
But it's certainly true of parts of the Chinese economy, particularly the local government sector, which is the agent of delivering economic growth, and the property sector, particularly the private sector developers, which are either bust or in all but name.
Right. Evergrande, for example, constantly in the news, George, at the moment. And let's just talk a little bit. We have seen a change in leadership at the Chinese central bank. Just talk a little bit about what that may indicate, or perhaps it indicates nothing. But do you think it is the start of a regime change?
No, I mean Pan Gongsheng, who is the new um, chair of the People's Bank of China. I mean, he comes with a good reputation, and I think people were quite relieved when he was announced as the new PBC chairman. And and he's smart man. He's been involved in lots of um, important activities at the PBC and in financial stress and so on in the past.
Mm.
But ultimately, he has to do what the boss says, and the boss is Xi Jinping. So, although I think he will be a voice, certainly within financial policy circles and within the regulatory framework, I think he'll be a voice of reason, and he'll carry some weight. Um, I mean, the PBC is not an independent central bank, and it must do what the State Council says, and obviously Xi Jinping governs effectively politics in China. So I don't think his presence at the helm of the PBC, although it's a good thing for the PBC, I don't think it really makes a big difference to economic and financial outcomes for China.
Last question for you, George, just to round out your time with us. If you look at part of the engine of growth in China, if you're really going back now before the huge investment in STEM education, for example, that we've seen in more recent decades, population growth was a part of that story. Talk to us a little bit about demographic changes in China at the moment.
Right. So China is now, it's not the oldest country in the world by any means, but it's the fastest aging country. If you look
Interesting.
at, for example, the change in median age, and if you look at the old age dependency ratio, which measures the proportion of people who are not over the age of 60 or 65 relative to the working age population. These are metrics in which China is really one of the hares as opposed to a tortoise. So even judged against the United States, for example, by the 2030s, 2040s, on almost every important metric, China will be a much older country than the US. So is this a crisis? I mean, I don't think it's it's a problem which lots of countries have, because when the working age population is declining, which in China it started to do in 2012, then there's two problems here about aging. One is who's going to look after grandma and grandpa, which is a problem that every individual has that issue. But the macroeconomic problem is when the working age population declines or stagnates, and more and more older people become idle or retire from work and depend on the productivity of the working age population, which is shrinking,
Right.
you've got a problem, right? You have to try to compensate for that. Now, there are coping mechanisms to deal with it, right? You can do only pretty much three things. You can have more immigration to make good the losses of working age people, but China's not very keen on immigration. But lots of countries have issues with that politically at the moment. You can improve the participation at work of people who are typically underrepresented, which is basically older citizens and women.
Mm-hmm.
But that's not as easy as it sounds, right? You can raise the retirement age, which China steadfastly plans to do and then refuses to implement.
And then Europe has struggled to do in practice.
Exactly.
Yeah, politically very difficult.
And for women in particular. Now, Japan is an interesting kind of contrast
Yeah.
because Japan has actually made a lot of progress by increasing childcare facilities for women and making it easier for women to have children and keep jobs or go back to work. So it can be done, but it's not really being done in China. And then obviously the third option is productivity growth. So if tomorrow's workforce is twice as productive as today's, problem solved. But it's easy to say these things. It's much more difficult to put these things into practice. But this is the agenda that China faces. It needs to find those coping mechanisms, as we all do.
Productivity initiatives in China, it sounds like a follow-up conversation, George, that we need to have. It's been such a delight to have you. Thank you for joining. This is Leading Indicator, folks, a source of insight from the world's best macro minds. And again, that was George Magnus, Associate at the China Centre at Oxford University. Thank you again, George, for joining us today.
Thank you very much.